I am Nur Adira Zulkifli, student ID 068247, and today we are going to talk about financial accounting. And the article that we are covering is that equity versus liabilities debate in the context of accounting for employee share options. Before we're going to present about our article, let me introduce you to my groupmates. In this group, there are 5 members, including me, Adira. There's Anurul Khalisa, Eliana, Wan Balkis, and Farhana. The content for our whole presentation based on the article given is that the first subtopic is the definition and characteristic of financial equity and financial liabilities. In this subtopic, we are going to explain what is financial equity and financial liabilities, and we are going to explain about their characteristic. And the second subtopic is distinguishing between equity and liability. In this subtopic, we are going to talk about the characteristics that differ these two. The third subtopic is the problems arise related to the issue discussed in the article. The fourth subtopic is approaches that might be used by the standard setter for the issue. And lastly, conclusion. Now, let's get to definition, shall we?
Hi, my name is Wan Balkis. First, I will explain about the definition of financial equity and financial liabilities. Financial equity represents the residual interest in the assets of an entity after deducting all its liabilities. It is a claim on the assets of the entity that remains after all other claims has been satisfied. Financial equity is typically issued in the form of shares such as common stock or preferred stock. Next, financial liabilities are defined as obligation to transfer economic resources that arise from past events and are expected to be settled in cash or other financial assets. Examples of financial liabilities include trade payables, loans, bonds, and other forms of debt. Now, let's look at characteristics of financial equity. First, holders of financial equity are entitled to participate in the profit and losses of the entity, and may also have voting right that allow them to participate in the management and direction of the entity. Second, financial equity has no fixed maturity date and does not carry an obligation to pay dividends. Third, financial equity is a risk-bearing instrument, meaning that the holder is exposed to the risks and uncertainties of the entity's operation. Four, it is essential for providing decision-useful information to financial capital providers. Next, I will share about the characteristic of financial liabilities. First, it is expected to be settled in cash or other financial assets rather than through the transfer of goods and services. Second, financial liabilities are recorded on the balance sheet at their fair value, which is the amount that will be required to settle the obligation in an orderly transaction between market participants at the measurement date. Third, the fair value of financial liabilities may be affected by changes in interest rates, credit risk, and other factors that affect the market value of similar financial instruments. 4. It is distinguished from other types of liabilities such as provision and contingent liabilities.
Assalamualaikum. My name is Farhana binti Haji Iqbal, and I will explain distinguishing between equity and liabilities. The key difference between equity and liabilities in a statement of financial position is that equity represents the ownership stake that shareholders have in a company, while liabilities are debts or obligations that a company owes to others. The main difference between these two is that the repayment of the liabilities is required by law, unlike the repayment of equity, which is discretionary. Also, in case of bankruptcy, all liabilities of a business need to be repaid before any amount is returned to the owners. Equity is used for buying assets or discharging debts of the company, while liabilities are a burden to the company and are paid off by the company its due course. Another distinguishing feature between liabilities and equity is that the return on equity, for example dividends and capital gains, is primarily based on business performance. In comparison, the interest rate of liabilities is usually a fixed and predefined percentage that does not vary with the future business performance.
The problems arise related to the issue in the article is that in the entity perspective and liability approach, you see the approach is giving ambiguous or arbitrary accounting treatment. This is because of the connection to the vagueness of the entity perspective in terms of reporting information to any particular stakeholder. Furthermore, based on review of Conceptual Framework 2013, the strict liability approach, which takes an entity perspective, has proven difficult to apply in practice. Secondly, the proprietary perspective and the narrow equity approach. This approach may not necessarily provide decision-useful information because it contrasts significantly with the well-established and well-understood means of classifying claims. Also, the merits of the basic ownership approach are not desirable goals of financial reporting unless they are associated with other benefits. And lastly, the ownership settlement approach. This approach, it relies on the definition of basic ownership instruments and is weakened by the same difficulties in identifying this instrument. Furthermore, in attempting to strike a compromise between the entity and proprietorship's perspective, the ownership settlement approach may fail to address adequately either perspective and may produce information of limited usefulness. That is all from me. Moving on to the next presenter.
So right now, I'm going to talk about the approaches used by the standard setter for this issue. There are three approaches, which is strict liability approach, narrow equity, and ownership settlement approach. So firstly, I'm going to talk about the strict liability approach first. So well established and has enabled standard setters, preparers, and users to resolve numerous accounting issues. This is because it concentrates on economic aspects, such as commitments and resources, that are pertinent to and understandable to users. The second point is it provides the most decision useful information for users. The reason for this is that a greater range of financial instruments used in typical corporate operations are liabilities. So number three, it is asserted because claims that are categorized as liability has observable significant qualities. The reason for this is because there is little mixing of heterogeneous claims in the liability category because these features are not linked to other classes of claims. Number four, it has proven difficult to apply in practice. This is because the liability in this context means both the existence of a current obligation and the conclusion of a settlement that necessitates the transfer of resources. Moving on to the narrow equity approach. So basically, it is criticized in four fronts. No distinction is drawn between the entity and its owners. Next, it is contrast significantly with the established and well understood means of classifying claims. For this, users of financial statements view certain instruments as being equity in nature. It makes financial statements less meaningful and make analyzing claims more difficult. Number three, the merits are not desirable goals of financial reporting unless they are associated with other benefits. It is not consistent with the objective of financial reporting to prioritize simplicity without a consideration of the consequence of this perceived simplicity. So number four, the simplicity associated with this approach will not be realized. The criteria are not conceptually justified. And the last one, only the most residual claim would be classified as equity. This means that perpetual instruments, such as non-redeemable preference shares, would be classified as liabilities. Moving on to ownership settlement approach. It defines equity broadly first and uses liabilities as the class of instruments that absorbs all non-equity items. Equity includes the basic ownership instrument and all instruments for which no settlement terms are present. So, talking about the next points, it confers some residual risk to the holder of the instrument. As a result, situations where a variable number of shares will be issued to settle an obligation are not deemed to be equity. But it may fail to address adequately either perspective and may produce information of limited usefulness. Therefore, the three models discussed provide different reference points that can be used to inform a review of the current accounting for share-based payment transactions.
Conclusion, the article tells us about the equity versus liabilities debate in the context of accounting for employee share options. IFRS 2 may arise when principles are established without keeping in mind the objective of these principles, including rich exploratory analysis of the equity-liability tension which the standard arise are scanned. Then the strict liability provides the most decision useful information to users as liabilities are well understood by this user. Furthermore, equity be using liquidation, subordination, or dilution do not appear to be feasible or practical criteria for use in reporting. In the article, using a comparable exploratory method, future researchers could consider the relevance and appropriateness of other construction of the elements of financial reporting. Additionally, study is required to compare views on financial reporting theory and practice from different contexts and for different types of transaction.